Recipes for technical trading success in Cook's Kitchen.
Hey everybody, who should you listen to about when the next rate hike is coming? Janet Yellen, the chair, or all the hawkish speakers that have been coming out lately? Even though they're non-voters, there's a lot of hawks out there that are making their stance known that, hey, we should be hiking 2 or 3 times this year. Or maybe even stick to the December plan of 4 hikes. We had a couple of guys saying that this month even. A lot of those hawkish speakers are, putting it out there maybe for their own political agenda. They want to be known as somebody who was trying to be ahead of the curve. But markets learned recently that maybe Chair Yellen is really in charge of this whole thing. So who should you listen to? I say neither. Listen to the market. I'm going to show you a great Fed watching tool that shows you where the market is on, probability-based bets, real money in the Fed fund futures, telling you when they think the next hike is coming. First, let's just go over the background here. In December, when the dot plot said, hey, 4 hikes are coming in 2016, I called that implied easing. Why did I call it implied easing? Because all they had to do was shift those dots down a little bit, and it was like, you got a rate cut. Well, whoa, look what we got this year so far. It's like they took away 2 or 3 possible rate hikes, and the market loves it. Why does the market love it? Number one, it took a bite out of the U.S. dollar. U.S. dollar strength was not helping corporate America, exporters, multinationals, and how that trickles down to manufacturing. And it wasn't helping the commodity space, with oil and the whole high-yield junk bond meltdown. So, taking that bite out of the dollar, giving us some implied easing, definitely, has fueled this stock market rally. Then we had the external effects, which they started including more in the FOMC statement. Janet Yellen referring to external forces, whether it's China or European banks, not naming them specifically, but acknowledging that, any kind of tightening here, we were already seeing global tightening. Okay, so we knew coming in to March, no rate hike, right? No rate hike in March, impossible. But then you get a dove like Bullard from the St. Louis Fed saying, hey, we're going to overshoot inflation, and the market is way too low on inflation expectations. Let's go to my tool now and see where the market is and why he's saying the market is way too low on inflation expectations. So what you're looking at here, this is from CME Group, where they trade all the interest rate futures in the world, trillions of dollars worth a day. And they created this tool, this FedWatch tool. So I'm going to scroll down here. You can just search FedWatch to find this. But so here's what you're looking at, the CME Group FedWatch tool. Right now, I've clicked on April 27th, which is the Fed meeting, right? And you're looking, what you see here is an implied probability based on the way the Fed fund futures are trading of, a 96% chance that the Fed stays pat. Circle that right there. And I just lost my tool a little bit here. Let me see what happened here. Bear with me. Still, okay, there we go. All right, so the market is implied. And I want to make the point that, Fed fund futures may not be the biggest, largest interest rate futures contract in the world. But what the CME does have and has had for over 25 years is Eurodollar futures, which is the interest rates on U.S. dollars overseas. And that is a huge business. They trade it 10 years out. So that these interest rate curves in the futures are really precision tools because you've got trillions of dollars every day determining where an interest rate curve is. So that filters over into the Fed fund futures and makes them very liquid. There's a lot of arbitrage between those. Okay, so there's April. We know, the market knows there's no hike. You and I know that, right? Okay, so let's go out to June. June is, let me clean this up here. So June is at an 85, 86% probability that the Fed fund futures will stay at where they are now, 50 basis points as the target. Only mid-teens forecast based on actual trading in Fed fund futures that they're going to hike another quarter point and go to 75 basis points on the target rate. Okay, so why is all this important? Well, remember, after the March meeting where we knew there was going to be no hike, the market was still thinking, hey, that means a June hike is coming. And Yellen gave a speech not even a week later saying, stop the madness, stop the insanity, because she let it be known that, hey, we're going to still be really cautious here. And she pointed to external developments. Why? Again, because of the dollar. She wanted to put the brakes on the dollar. And that's sort of the linchpin here, especially as the ECB, the European Central Bank, and the Bank of Japan, the BOJ, as they go to negative rates and do everything they can to stimulate their economies by keeping their interest rates extremely low and in a negative territory, the Fed can't move away from that because that will instantly strengthen the dollar. So she's bending here. She might point to external developments or the job market or low inflation, but really I think it's about the dollar. Okay, so, and then, that's a feedback loop. So where are the inflation expectations? Let's go back to the tool and see how far out we go here. So I'm showing you June here with this, and this is as of today. The other interesting thing to note here is I saw Scott Minerd of Guggenheim on CNBC yesterday. He had just come from a meeting with the New York Fed. On Thursday, Scott Minerd of Guggenheim, they managed $240 billion. He was at a meeting with the New York Fed. So, the guy's practically an insider. And I call him my favorite bond king. He's been, in the past 3 years, he's nailed the 10-year Treasury trade, all the swings, and calling for lower rates. He's just nailed it, better than Gross or Gundlach combined. So that's why I think Scott Minerd is the real bond king you want to follow. But what he said is that the Fed is hostage. What are they hostage to? He pointed to the Brexit vote, June 23rd. There's a referendum in the UK on whether or not they should stay in the European Union. That meeting's the 23rd. Let's go back to our tool. When is the June Fed meeting? The 15th. So Minerd says that the Fed is hostage to Brexit. They're not going to hike in June. And the market is already there. The market believes that. I should point out here, you can look at previous probabilities right up here. You can always see where was the market a month ago to kind of gauge how much has sentiment changed, how much has real dollar flow changed in these instruments to project the probability. So let's go out to July. Okay. Oh, one moment. Still learning how to use this new fancy drawing tool here. Okay, so where's July? Okay, now we get into, maybe, because there is a July meeting. There's a late July meeting. And the market is telling you that only 71.4% probability, well, I say only, the majority probability, the majority case here is that Fed funds will not change. And only about let's just call it a 1 in 4 chance that the Fed moves in July. So what do you think the odds are, given, let's say the Brexit vote goes fine and there's no explosion in volatility, with the UK leaving Europe, leaving the European community. Summer volatility is fine. They avoided that. So the Fed goes ahead and hikes in July. Hey, maybe they could. But what do we got coming up in the fall? The election. And who knows, if they want to, throw that into the mix. Again, it all comes down to inflation expectations. The market has been right about inflation expectations, that they will remain low, especially in this environment. Are negative rates working in Japan? It doesn't look like it. So The Fed, the psychology here is that the Fed has shifted from feeling they need to get off zero and raise rates to have credibility to now they've established the case where it's okay to wait, and the market loves it. And the market's not afraid of the Fed's outlook because we've seen, hey, that first quarter GDP could be negative. So, why would you hike rates into that? There's very little inflation. In fact, they want inflation to overshoot. They told us that. So what I'm building up here is that there might only be one rate hike this year, and it might not come until December. Given all these forces combining, and the Fed, there's obviously huge debate on the Fed. You want huge debate. You want the world's top economists debating this. You want them out giving speeches and expressing their opinions, even if there's some political motivation, because you want to hear the debate. And the debate is so out there that it almost becomes the Fed's bluff that, hey, we're really interested in hiking rates because the economy is so strong and we think inflation is going to hit 2% maybe later this year. So I think that's the Fed's bluff, and we'll probably be lucky if we get one rate hike this year. I just want to read one quote here from Jeffrey Lacker. At one point in the past week, he was quoted as saying that he felt the Fed should have stuck to their December plan for 4 rate hikes based on the economic data. And this is interesting. He says, the Fed's monetary policy mandate is solely focused on domestic economic conditions, employment, and inflation in particular. But you know what? They don't really believe that. He's backed off of that now. And this is Lacker from Richmond. Because the external conditions do matter. There is that feedback loop. So this is why even the hawks. There's a guy named Harker. I forgot where Harker's from. New Fed guy. Very hawkish a few weeks ago, calling for 4 rate hikes this year. Now he's backed off of that. So, all of that hawkish talk is really a bluff right now because the Fed can't do anything. And if you want to know where they're at, let's take a look at the tool again. Just keep tracking this. Go to the CME FedWatch tool, and let's flash ahead right now. What are expectations for September? Now, September, you're getting a little more realistic. And there's a 7% chance of them moving 50 basis points. Okay, that's pretty small, and and that's still that outlier. Well, that's the outlier, but the majority case is still the Fed will stay at 50 basis points in September. Again, this is not just inflation expectations. It's also about the global linkages and the credit event risks coming up between Brexit and the election. Okay, I have beaten this dead horse enough. Use the CME FedWatch tool. It'll tell you where the market's at, and the market knows better than anyone, probably, than the Fed when the next hike is coming. All right, I'm Kevin Cook. Thanks for watching.